Joining us right now is CFRA Chief Investment Strategist Sam Stovall. Sam, good to see you. Thanks so much for joining us.
Happy to be here.
Look, I think the president yesterday basically said he wasn't happy with the China trade talks right now, and that sent markets lower.
Oh, sure.
Is the market focused now more on trade as opposed to earnings, which have been very strong?
I think so. I think really this is more of a technical move that's being blamed on by trade. We just broke out of what's called a continuation pattern, a descending wedge, which is positive. And now we're sort of going through the digestion phase, the backing and filling. And what was interesting was that we went right up to the top level of resistance at about 2737 on the S&P 500. And then let's blame trade, and that brings us back down again. I think really the president is going through a classic negotiation phase where you offer a little bit of a carrot, and then you try to pull that carrot away to get to the other side to be more willing to negotiate.
What happened is sell and May go away, right? I mean, it's that hasn't really worked out over the last few years. Have we seen that change, or should we be more sector rotation, right? Should we be getting out of certain sectors and into others as opposed to just broad-based selling the market?
Good question. I'm a big believer in rotate, don't retreat, meaning in the sell and May period, yes, historically it's a pretty weak period, but it usually rises about 6 out of every 10 years. So basically you are better off focusing on the more defensive areas. Right now, cyclicals are doing the best. However, I think we didn't do enough penance in the most recent correction. So if we get back to break even, like a whale going up for air, I think we head right back down again. Usually the third quarter is the most challenging, and watch out for September.
But in a midterm election years, the second quarter, in terms of the S&P 500, the performance is usually the worst during the second quarter, down on average 2.2%. According to Lindsay Bell, with whom you work. But so we're only got a month left in the second quarter. So
okay.
So could June be ugly?
I think what it also implies is that the market has actually declined in the sell and May period 60% of the time in first-term, midterm election years. So there's still the possibility that we end up in negative territory for this entire 6-month stretch. I think what it really means is, you know what, we're going to be spinning our wheels, that maybe we don't get a lot of traction until the uncertainty of the midterm election is over. But a good factoid is that in the 1 year after midterm elections, the market was up 18 of 18 times with an average increase of 16.5%.
Regardless of who won?
Exactly. Just because the uncertainty was resolved.
What does the retail earnings tell you about all of this? We had retailers in focus this morning reporting really a mixed picture. A lot of companies missing estimates. Tiffany's was the standout. The stock is up right now, 11.5%. The luxury retailer reporting better than expected earnings. It also raised its full-year forecast. But the others, Lowe's and Target, had some misses, and their stocks are showing it. Target down 5.25%. Is this just a bifurcated sector? What's going on?
Well, I think, yes, it is. You've got some of your better companies that are reporting stronger earnings. We had a nice surprise with Macy's about a week or so ago. So I think what it's showing is, yes, unemployment rate below 4% is good for the consumers. We are seeing a bit of a softening of consumer sentiment, a little bit of consumer spending as well. But I think it's really just a softening period. But retail still is doing relatively well and probably should contribute to the market's advance later on.
So is any of this priced into the market, do you think? Or in terms of, you said that things will slow down because the second quarter is typically weaker than the rest. Is this priced into the market, do you think?
I think in earnings, people are worried that we have hit a peak in the first quarter, up 26%. Expectations were for us to be up about 17%, so we're doing much better than expected. We're probably going to see maybe 18 to 20% growth in the second quarter, but back up to about 20+% growth in the third quarter. So investors are wondering whether maybe the best is behind us.
The only concern I have is look at what's happening to input costs, whether it's the rising 10-year Treasury or look at what's happening to oil. I don't know, is that a new tax now on the gas pumps where it's going to be trickling into the consumer economy, right? We're talking about retail earnings. How is that going to impact the market going forward?
In terms of consumer inflation, a lot of businesses haven't been able to pass on their rising input costs, something that Stephanie Pomboy has talked about over and over
which will
again.
impact the operating earnings, which is harder for the stocks.
It will hurt earnings, but again, if you can pick those businesses that can pass on to the consumers or that have a resilient consumer, that's
so just buy Amazon. That's it.
Well, no, you're bringing up a good point.
Just don't return anything.
But I'm talking about like every business from Caterpillar to Cisco, whether it's rising freight costs and other input costs, whether it's even their own energy prices.
Well, I agree with Cisco, the food distributor.
That's what I was talking about.
Okay. My feeling is, I mean, we're in a rising rate environment. Historically, we find that it's the cyclical sectors that do best in a rising rate environment, and it's the more defensive consumer staples who are not able to pass along the higher costs to their consumers that usually don't do.
We've already seen that play out in the market. Staples have been just obliterated.
And they need a catalyst to be able to bring them out, and it could be a rotation. Simply, if we do get another dive down in share prices, we could see a flight to safety into these more defensive areas.
Good stuff, Sam. Thank you so much.
My pleasure.
Sam Stovall joining us.